love the channel and find it useful in becoming a happy retiree. Subscribe today. Good morning. Welcome to Money Matters. We were going to talk about active versus passive investment management. There's this giant debate going on Wall Street. The debate is heated up more than I've ever seen it in my 20-year investment career, so it's something we want to get to. So first quarter economic growth just released at 0.7, so a little less than 1% for the first quarter. That's a pretty slow reading, the slowest we've seen in 3 years. GDP rose less than half of the economy's typical performance. It's been around 2%, therein lies the problem, and that's what we've seen all around the world. Fascinating chart. If you go back to 1966 and you just draw a 3% trend line with GDP, you've seen all the way from 1966 all the way to the financial crisis. So through the 70s, 80s, 90s. Yes, and we had some dips and recessions, but the actual GDP growth hugs this perfect 3% line for the most part. Again, sometimes when we didn't quite hit it, times we overshot it, but for the most part from the 60s all the way until 2008, we as a nation, we've grown gross domestic product by a rate of 3.1% year after year after year after year. That broke in 2007 when we hit the financial crisis, and it's been broken ever since. That lies in this giant political change we've seen, not just here in the United States, but all over the world. Now, and since the Great Recession, we've been growing at about 2% a year. So since we've recovered, it hasn't been a disaster, but it's just slower nominal growth. The difference, if we would have been continuing to grow at 3.1 versus the 2 that we've been growing, it's created about a $3 trillion gap, $2.8 trillion to be exact. And that has left Americans feeling like they haven't gotten ahead, hence the political winds of change that have happened here in the United States and around the world. So there's an awful lot to catch up on here. Of course, last week we started talking about the concept of dividends and why dividends don't lie. And that's something I've written about. You can find that on clarkhoward.com. You can find it, well, go to clarkhoward.com and you can find a piece I talked about several reasons, 5, I believe I would put a bonus reason, so 6 different reasons why dividends make sense to me as an investor, as a philosophy. And I was in Florida this week doing several talks about income investing. So what do you do in a rising interest rate environment? What do you do with the stock side of the equation? What do you do with the bond side of the equation? What do you do with closed-end funds and REITs and MLPs and all the areas that make up all the pistons in the engine? I think of an investment portfolio as let's call it a 6-cylinder engine, and you've got 6 separate areas that are all generating horsepower or income for you, all in slightly different ways. Some are dividends, some are interest, some are distributions. Some of those pistons go in and out of favor. Today, the way I see it here is that dividend-paying stocks, it's still one of the main areas of growth. MLPs, the pipeline industry, still looks attractive. REITs, not as much. Closed-end funds, not as much. Bonds, not as much. But at any given time, you're going to have all of those 6 working for you in some capacity. But you may have a period of time where 2 or 3 or 4 of them are working or producing even more or even a better value. And that's today, I go around the country talking about that and try to help investors understand what areas of income investing right now are the most advantageous. How do you build a long-term strategy that you can live with that generates income? And it's not a perfect science. It's not the only way to do it. So I get questions, well, Wes, what about growth investing? You know what? There's nothing wrong with it at all. You buy Apple or Google, not Apple because Apple's a dividend-paying stock now. You buy Google or Facebook or Amazon, any of these companies that have been these wonderful growth companies, and they don't pay dividends, and that's not an income-oriented investment, and that's fine. It doesn't mean that, so when I talk about income investing, it's not the only way to do it. In fact, an interesting statistic, it's just the way I do it. It's the way we do it with the team of investment advisors that I work with, and it's a big part of philosophically how we believe in investing, which leads into this big question mark about active versus passive investing. Another quick, interesting historical note as we live and walk through history of markets. The NASDAQ hit 6,000 this week and has hit 25 record closes in 2017. That's the most all the way since back in 1999. If you look at where we are today, again, a lot of that activity and a lot of the rise in the NASDAQ is coming from just a few soldiers, if you will. Facebook, Amazon, Netflix, and Google, which is parent company Alphabet. Those companies, if you put those four companies together, they exceed the gross domestic product of South Korea. They exceed the gross domestic product of Australia. That is how gigantic and dominant these companies have become. And Jim Cramer was jumping up and down on, I think, Friday morning or Thursday or Friday of this week about how Domino's is the best stock that's ever been. Domino's Pizza, to be exact. And he recalls back about a decade ago, stock is at $10 a share. Having the new CEO on, and Jim Cramer says, you know what, your pizza is awful. It's the worst pizza I've ever had. And the CEO didn't defend it. He said, actually, he said, yes, you're right. In fact, our pizza's so bad that I would rather eat the cardboard box that our pizza comes in. And then over the next year or two, they straightened a pretty important problem out, and that's the taste of the pizza. So they fixed that problem. And then, like no other pizza company, from a technological basis, figured out a way to make it so easy for you to order Domino's. And now you can order Domino's from your watch. You can order it online. You can order it on Facebook. You can order it in an underwater scuba diving capsule somewhere from your shoe. That's how easy Domino's has gotten. And today, Domino's is close to $200 a share. $10 to $200. And that is the kind of rise that makes any investor think, well, wait, why didn't I do that? Why didn't I just find Domino's? Why didn't I find the next Domino's? Well, it doesn't really go back to income investing. That is home run. That is big game hunting, if you will. And it works sometimes, but there are a lot of misses along the way. Income investing is really a more methodical approach that generates income monthly and monthly and monthly. And none of it is extraordinary in any given year, but over time, 3 and 4% every single year on top of growth can make a lot of sense, or at least to me. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.